Welcome back, everyone, to the next module in our trading journey. Today, we're going to be diving a little deeper into price action formations. Since price action dictates all of our trading behaviors, we're going to spend today's lesson expanding on our knowledge and relating it back to trade execution. So without further ado, let's jump right in. So first of all, I want to go over the various candlestick formations you may encounter while observing price action. Now, if you'll remember from the very first module in our previous course, we introduced single candlesticks. Candles such as dojis, spinning tops, hammers, shooting stars, and even marubozu candles. All of these showcase the buyer and seller psychology that occurred during a specific trading session. But now let's take it a step further. What happens when we have candlestick formations consisting of 2 or even 3 candlesticks? Since each candlestick represents one session for the time frame being analyzed, we start to piece together the larger picture when we begin identifying multi-candlestick formations. If we pair this with key levels of support and resistance, we start to understand the type of market we're in, as well as any discernible trends. So let's start with bullish and bearish engulfing candles. These are considered 2 candlestick formations. They occur when one session engulfs the previous session's trading range in the opposite direction. So, in order to have a bullish engulfing formation, we need to first have a down candle. This candle represents sellers being temporarily in control. The next candle, however, is a green marubozu, or up candle. It completely engulfs the down candle and closes above both the open and high of the previous session. This is a clear indication that buyers have stepped in and taken control of the market. The opposite can be said for bearish engulfing candles. Here, sellers take control from the buyers by closing below the open and the low of the candle. Bullish and bearish engulfing candles are great formations to use as triggers after identifying a key level in a potential trade setup. Now let's talk about tweezer tops and bottoms. These are slightly less frequent 2 candlestick formations. They are identified by 2 trading sessions having equal highs or lows respectively. They are usually hammers or shooting stars, since those type of candles tend to have long-legged shadows on either the top or the bottom of the session. They exhibit one party's inability to push price further. So as you might have guessed, these are usually strong indicators of a potential local top or bottom. Now, let's move on to 3 candlestick formations, such as the evening and morning star. In order to identify this type of formation, we'll want to have a strong up or down candle first, usually a marubozu. Next, we'll want to see an indecision candle, usually a doji or spinning top. This indecision in the market gives us pause that we may see a reversal. The third candle, however, has to close at least halfway past the body of the first candle. You'll notice I said the candle has to close, not just trade below. The reason we wait for the candle close is because it confirms that control has shifted from one side to the next. In an evening star formation, buyers were in control of the trend until they reached a supply zone and formed an indecision candle. Sellers then confirmed the reversal by pushing price below the midpoint of the first marubozu candle. The same goes for morning stars. Buyers who are able to wrestle control from seller indecision exhibit strength by closing above the midpoint of the first down candle. The next 2 formations I want to talk about are my personal favorite when it comes to identifying triggers in the LTE methodology. 3 inside up and 3 inside down formations. These are similar to the evening and morning star, with the initial prerequisite being a strong first down or up candle. The second candle, however, is not an indecision candle. The second candle has a larger real body that closes at least halfway past the midpoint of the previous candle body. From a psychology perspective, this is one party's way of fighting back and taking control of the previous session's trading range. The third and final candle in this formation will close past both the open and high or low, depending if it's a 3 inside up or down. In a 3 inside up, the third candle will close above the open and the high of the first down candle. In a 3 inside down, the third candle will close below the open and low of the first up candle. I'll tell you from personal experience, as well as frequent journaling, that 3 inside up formations tend to have a high hit rate for trend reversals or continuation at key SR levels. If you remember from the previous module how I said that triggers can be entries, but entries can't be triggers, this is a great example of where a successful 3 inside up formation can be used as both a trigger for a level as well as an entry upon the successful close of the formation. Now lastly, I want to touch on two very in-your-face formations, the 3 white soldiers and 3 black crows. These are considered the most obvious formations of a trend reversal or continuation. They do have important rules for identification that should be adhered to strictly in order to ensure the probability of their success. 3 white soldiers are essentially 3 up candles, one after the other. Now the first candle is usually a Maribozu, or even a bullish engulfing. The second candle has to have a body that is twice as large as the first candle, and should have little to no upper wick. It also shouldn't have a lower wick. The reason being is that it needs to show clear dominance from the buyers, who are now stepping in to push price even higher. The third and final candle in this formation should be a third up candle without a lower wick. It needs to be at least 1.5 times larger than the previous second candle's body. Once you observe price action that fulfills all these prerequisites, it's very likely that you will see trend continuation to the upside. The same rules apply for 3 black crow formations, except in this case, all of the candles should not have upper wicks, which show the sellers flexing their strength to push prices lower each subsequent session. Now that we have a better understanding of all the different kinds of candlestick formations, let's do a quick recap and make sure we grasp all the key takeaways. If we remember from the first course, we briefly went over Japanese candlesticks and how they reflected buyer and seller psychology. Today, we took it one step further and looked at multiple candlestick formations and what they tell us in that ongoing conversation between buyers and sellers. In the last module, we discussed the LTE methodology and how we can use this consistent approach to defining and executing our trade setups. Today's lesson reinforced just how effective price action can be when used as triggers in the LTE framework. Remember, we'll want to combine these price action concepts with key support and resistance areas in order to enhance the probability of a favorable outcome. Lastly, we're going to want to learn how volume plays a role in adding confluence to our trade setups. Trip will be going over that in more detail later in this module, but for now, just remember that volume is a tool for confirming candlestick formations as well as our trading bias. In the next video, we're going to look at some examples of price action and see if we can identify any of these formations in real time. And remember, practice makes perfect. Outside of these modules, you should dedicate ample time to observe charts and understand what's going on. All the education in the world won't help you become a great trader if you don't start to train and apply your analytical skills on live charts. Thanks for watching, and I'll see you soon.